Indian industry is clearly suffering from demand deficits in both domestic and external markets. Demand deficits may be the reason private investment has not picked up momentum despite the company's healthy balance sheets and all the reforms and incentives extended by the government. This is what Nagesh Kumar, the only member of NPC to have voted for 25 basis point rate cut at last meeting said, and he has been proved right. Now, coming to market outlook, obviously this week the GDP numbers of India are critical. The Q2 GDP growth came at 5.4%. The State of Economy report by RBI had estimated Q2 GDP at much stronger 6.7. Hence, it's a big shocker right now, 5.4, because it was not predicted. And anything which is not predicted is not in the price. Will the slowing growth lead to rate cut at the MPC's meeting next week? Now, RBI and government had argued that slowdown in Q2 was temporary, but the Finance Ministry's full year growth estimate of now 6.5 to 7% looks difficult because there is no momentum right now in the economy. Now, RBI's clampdown on unsecured credit has also led to a slowdown in bank credit growth. Hence, economic rebound from this position will take time. Now, retail inflation for October at 6.2% is well above the upper limit of RBI's inflation target. A sharp surge in food prices is one reason why there is a surge in retail inflation. Even core inflation has edged up. Hence, probability of a second order effect of higher primary food prices is high. Second order effect is that over a period of time, if the food prices remain higher, then the inflation start going into the cost of labor and for cost of all other issues because it's a basic raw material for all requirements. Flash PMI for November, which I had covered last week, also shows core inflation is moving up. It is biting urban consumption, corporate earnings, and capex. Under these circumstances, MPC will have to decide on policy rates next week. So it's a difficult thing, but they will do something to at least ease liquidity. There are other ways to bring down the rates other than cutting repo rate or something like that. Now, coming to the details of the GDP data, private final consumption expenditure declined. Growth in private final consumption expenditure fell from 7.5% to 6% in Q2. That means basically, other than the government, even people are not spending and it is going down. Corporate commentary indicates rural consumption is reviving, supported by GVA in agriculture, which has gone up from 2% in Q1 to 3.5% in Q2. So that is one good part. But the urban consumption, which was really driving the economy, is slowing. Growth in gross fixed capital formation is lower. Growth in gross fixed capital formation fell from 7.5% in Q1 to 5.4% in Q2. Now, sectors that generate jobs for the masses are slowing. Now, construction sector grew by 7.7% in Q2 versus 10.5% in Q1. Manufacturing just grew by 2.2% and mining by minus 0.1%. So basically, the sectors which create jobs are the ones where the effort has to go in to support consumption. Flood of freebies being promised in recent state elections while supporting mass consumption is likely to affect capex by the state governments. Now, the point is that as the government has been bringing down the fiscal deficit, the government spending is going to come down so that high rate of government spending post COVID is not going to continue. Add to that, there is a problem of global uncertainties with the change in US government, higher tariffs, which everybody is likely to put on everybody else, then push towards Chinese imports, strong dollar, and outflows from capital markets are all becoming big risks now. On positive side are higher rural spending and increase in government expenditure, which is now going to start off from here. But government is struggling to revive spending after the general elections. It has been a while after general elections are over, but government spending is not really getting revived as such. Uh, Current divergence within household spending. There is a divergence in household spending where premium consumption, investment, and real estate segment continues to outperform the mass low ticket spending. Hence, HUL, Nestle, etc., are complaining about low growth and low demand. Now, if personal income doesn't pick up, then it will pull down the entire economic growth. Now, coming to the US economy or US markets, Trump spoke about 25% tariffs on goods from Mexico and Canada and additional 10% on products from China. Uh, while they had US had a GDP growth for Q3 came at 2.8, and core personal consumption expenditure price index, which they follow, which Fed follows as a for adjusting their rates, came slightly higher. So what it implies is inflation is not fully under control, and also the dollar weakened due to three major currencies turning positive. That is euro, yen, due to possible rate hike in Japan, and yuan. So now coming to US yields, they were rising and they fell. It is just a correction, but it fell last week. So this has to be seen now that now will it reverse for some time, retrace, and then start rising based on the narrative. Similarly, dollar index it corrected, but it corrected because the dollar because the three currencies against which it is pegged against were rising. That is euro, yen, and yuan. So it is basically because of that. Brent crude corrected, but still within that range. Gold again, it had gone up, it came down after the dollar strength, then it went up, and now it is again coming down. So this is continuing. Copper is coming down and now below the 50 EMA, basically because there is lack of demand which is expected from China. Bitcoin also, which was having a vertical rise, has now come down, has stopped at around that $100,000 level. So it is now pausing at that level, looking for kind of fresh triggers, and maybe there is some kind of profit booking also taking place here. So we'll have to watch this now. This will move with further announcements, etc. Nasdaq was only up 0.74%, just halting the rally, but it's on a constant upward trajectory. Dow was up 1.39% and continues to make fresh highs. Now, if you see here, India VIX one day, it declined 5.19% on Friday. So it came down to that 14.42 level. So this is interesting. So it brought all the premiums down. Nifty 50. This is a weekly chart. So if you see here, uh, the rise from the uh, lows of the election day to the high it made at around 26,300. It retraced approximately 38.2%. It had come down to that level, and now it is going in between and now trying to test that uh, 20 day moving 20 weekly moving average. So this has to be seen. The last week, what happened was, firstly, in anticipation of the ruling party's victory in Maharashtra, there was a bounce on Friday, and then there was a gap up on Monday. But that gap up halted at around this level, which is the 50-day moving average of around 24,350 odd levels. And it made constantly highs there, couldn't sustain there, and then fell on Thursday, and then slightly bounced back. But this gap which it made on Monday, That gap has been filled. So, but the good part is that it is above the 20 EMA. So till the time it is above this 24,050 level or 66, which is the 20 EMA, it is positive. So any close below that, then this low of 23,850, which it had made on last week on Thursday, will be the critical level, and then the support at 200 EMA. So these are the critical levels. Now, hourly charts, if you see here, uh, it got oversold and then it bounced back. Then there was a gap up, and then on 25th, and then it just maintained itself around these levels. And there was a sharp sell off. And now on hourly charts also, it has closed above 20 EMA. So that is positive. So the time it is above the 20 EMA on hourly chart, short term, the trend is positive. Nifty Bank made a doji on the weekly chart. It is much better than Nifty as such because it is trading above the 20 EMA on the weekly charts. So, and it has not tried to fill the gap which it created this week. Now, on the daily charts, also, if you see here, it is trading above all the moving averages. So, it is looking good. And in case that it gets some momentum, it can go up from here because there are no major resistances it has on the at high levels. So, this is looking a slightly better chart. HDFC Bank went through that hump of around 1800, went above that, and that was the one which was leading Nifty Bank and Nifty up. So right now it is above that. It tried to break that, but didn't break. So it is above this 1800 level. So this 1800 level or this zone is important. If it sustains above that, then one it will form a base here and then go higher. Otherwise, it can go and test the moving averages at the lower level. Similarly, with Reliance, it tested that 200-day moving average on the weekly charts, bounced from there along with the market. So now it is in between and it can go anywhere right now. Midcap index was positive, didn't fill the gap, though it is just below the 20 EMA, and it has to trade above this level of the high it made on the election day. Similarly, with small cap index, it is above this level and now trading above the 20 EMA on the weekly charts also, and has not tried to fill the gap. So, other than Nifty Bank, mid cap and small cap charts look good. Now, coming to stocks, first is Hitachi Energy India. Robust operational performance backed by superior execution. Order inflow of 1950 crore registered on 12% year-on-year growth, leading to an order backlog of approximately 8910 crore, 18% year-on-year. The company's annual order inflow has grown over the past 2 years from 3200 crore in calendar year 20 to 5530 crore in FY24. So basically, it has orders worth more than a year. Given the traction in key target sectors like HVDC is high voltage direct current. It uses DC for electric power transmission in contrast to AC transmission. They recently won an order from Power Grid for 800 kilowatt HVDC link from Khavda in Gujarat to Nagpur. Then their key sectors they are targeting are high speed rail and data centers. Expect this ordering momentum to continue in the near to medium term. It has been focusing on scaling up exports and services revenue and has been witnessing strong traction in ordering within its exports, now comprising 22% of the total order book in second quarter FY25, with a significant share from high voltage products and grid integration orders from European and African markets. Key large orders are coming in from transformers and power quality segments spread across industries, transportation, utilities, and data centers. Even sectors like renewables, transmission, data centers, railways, and metros are witnessing strong business traction which can further scale up execution. It should deliver a sharp improvement in margin going ahead from current 7.1 that it has reported, given the large ticket orders in HVDC up for finalization and strong transmission and distribution capex. Key segments: industry 78% year-on-year growth, data center 46% year-on-year growth, and transmission 34% year-on-year growth. So now let's see their quarterly performance. The total revenues was up 26% year on year and 17% Q on Q. And for the full year also, it was up 27%. So they did around 2,800 crores or 2,900 crores in first half. Just remember this: 2,900 crores in first half. EBITDA was up 68% year on year and 129% Q on Q. EBITDA margins, this is the reason why the EBITDA is up, because margins have improved 7.1 uh, from 5.3 earlier. Profit before tax is up 118%, and net profit is also up 111% and 400% Q on Q. So this is the reason why the stock is in news. So you see order book providing strong revenue visibility of 1.95 times trailing 12 months revenue. So that is one positive. Order inflow witnessed a growth of 12% year on year. Gross margin expanded 310 basis points year on year on account of improved revenue mix. And revenue mix means they are getting orders where the margins are higher, and strong execution led by 27% year on year growth. EBITDA margins expanded by 170 basis points. So they are targeting 10% plus, and PAT registered 111% year on year growth. So this is driving the stock prices. So as I had covered, they have done roughly 2,800 crore in the first two quarters. That is first half of the year. So they are targeting around 6,500 crore revenue in FY25, which is possible because generally the third and fourth quarter are the strongest. And from here, they are targeting roughly around 29 to 30% revenue growth over the next 2 years from here. And they are targeting, because of this and better margins, they are targeting an EPS of 183 in FY26 and 288 in FY27. So roughly take a mean of 220 to 30 for both FY26 27. Revenue growth is expected to be strong, and profit after tax is expected to grow more than 100% over the next 2 years. EV EBITDA is declining, so the valuations are becoming reasonable. ROE is improving. ROC is also improving. There is no debt, so that is positive. EBITDA margins, they are right now, they were in that single digit 5 6. From here they are likely to be reaching around double digit from FY26 and higher because of that. And PAT margins are improving, so that it is higher revenues, higher margins that should drive profits. So if you have seen 220 to 30, uh, so if you see this stock, it was around 5,000, 6,000 levels, and it has gone up, made a high of around 16,000 plus, and then declined. Now here, if you see here, it got that order of HVDC. It went up 10% from the lows here. It went up nearly 10% and then came down, and now it is come down to below 12,000 levels. So in my opinion, somewhere close to around 11,000 level, that is 200 EMA, is a decent level to get this stock. uh, so if you see future or the forward EPS for FY26-27, if you see around 220 to 30 at 50, 60 times, this should trade at around 13, 14,000 rupees. So that should be a fair price for the kind of growth they are having. So this, so buy with a margin of safety, because there can be always be some error, some mistakes, it may not perform, etc. Now the next one is Titagarh rail systems. Operational performance marginally below estimates led by weaker passenger segment execution. Freight rail margins declined 90 basis point year on year. Expect execution to witness traction. Order book at 12,200 crore is supported by private wagons, Vande Bharat, Ahmedabad Metro, and Surat Metro orders, providing healthy 3.1 into trailing 12 months revenue visibility. It started the year by producing 2,070 wagons and expects to do a monthly run rate of 900 wagons per month to reach an annual goal of 12,000 wagons in FY25. So annual goals of 12,000 means they plan to do around 1,000. So they are reaching around 900. So they want to make 1,000 wagons a month. Order backlog for freight rolling stock stood at 5,360 crore. Freight segment to deliver a revenue CAGR of 19% over the next 3 years. Market opportunity in passenger segment remains robust at 35,000 to 40,000 crore, which creates significant traction. With a market share of 20 to 25%, order backlog stands robust at 12,200 crores, providing strong medium-term revenue visibility. It recently commenced production of train sets for Bangalore Metro Rail Corporation Limited, Phase 2 Yellow Line project, and aims to dispatch the first train by third quarter FY25, with gradual uptake to deliver two trains per month by fourth quarter and FY25 and first quarter FY26. They have an order for six-car configuration, this Bangalore Metro Rail, and total order is for 34 trains and will be starting with one train per month and gradually increasing it in another 4 5 months to two trains. Designing and progress is on track for Surat and Ahmedabad Metro Rail also, and they will start production going ahead. Probably they haven't received the uh, orders to go ahead with it completely, so they are in the designing and progress phase. It has an investment plan of 600 to 700 crore over the next 3 years. So if you see here, year on year the revenues rose 13% and Q on Q around 17%, and they did around 850 crores in first half, and the sorry 1960 crores in first half, up 6.2 6.2% year on year. EBITDA also improved 12% and 27% Q on Q. So first half was slightly low key. Year on year, it has improved 4.5. EBITDA margins are generally at the 12% level, so they have not gone up much year on year, slightly up Q on Q. Uh, PBT is up, profit before tax is up 20% plus, and net profit is up also year on year 20% plus. So remember this data, 1960 crores in first half. So if you see here, freight rail system had a year-on-year growth of 24.9%, but the passenger rail systems became nearly down by 58%. So this is one reason which is slowing the growth of the company. Freight rail system EBIT was up 16% and passenger rail down 2%. EBIT margins also for freight rail, actually EBIT margins came down, and for passenger rail system the EBIT margins went up. So revenue growth of 13% led by freight segment. Gross margin improved 150 basis point because of better revenue mix. EBITDA margins contract by 10 basis point. Registered PAT growth of around 20% year on year. Freight rail segment registered 25% year-on-year. Freight rail segment EBITDA margins contracts 90%. Passengers rail segment registers a decline of 58% year-on-year. So actually, the management has not guided for this, and passenger rail segment EBIT margins went up because they are doing slightly better orders. So now, if you see here, as I had shown you here, uh, they have done first half, if you see added up, they have done 1960 crores. So revenue. And so if you see here for FY25, they are guiding for around 4,565 crores. So that should be achievable. But in my opinion, the way they are going to 7,130 crore, that is 56% year on year revenue growth, is looking slightly difficult for next year. So this has to be seen as to how much is their revenue recognition, because market is pricing, though these estimates have also been brought down. The revenue estimates for FY26 and 27 have been brought down already, but I think they are too fantastic still, because the trend is not that good as such. So we'll have to see this. Similarly, net profit is expected to be nearly doubling over the next 2 years, and EPS from 30 odd in FY25 is expected to grow around 50% plus in FY26, etc. So 51%. So this has to be seen now over a period of time. The EBITDA is coming down. ROE is improving. EBITDA margins are also generally static. So that means if EBITDA margins are static and PAT margins are also static, they can only improve the earnings if they have higher revenues. And so one has to see how much revenues are booked over the next year and what is the management commentary. So if you see here, the stock in June made a high of around 1900 and has nearly halved after that, came down to 1000 plus levels, and now it is at that below 200 EMA, and now it is just at 200 EMA at 1200 odd levels. So one has to see this, though the outlook looks good and the commentary is good and they have good order book, but one problem is execution, and I think there is some problem with order inflow, actually order inflows and all that. So I don't know, because the freight is okay, but the passenger segment is not growing. So that means probably they are not getting the go ahead to execute and all these orders. So that's why it is reflecting in the stock price. So one has to see the what is happening with this stock, though on in terms of narrative and commentary it looks good. Next is SRF. Uh, Revenue miss is on account of 9% slippage in chemical business, with technical textile business TTB plus 6% year on year, and packaging film TFP 27% year on year. Sales were in line. EBITDA margin slipped 290 basis point versus expectations of 16.4%, 150 basis point Q on Q, and 390 basis point year on year on account of 280 basis points slippage in chemical business impacted by underperformance in specialty chemicals and lower prices, and 370 basis points slippage in packaging margins impacted by Chinese dumping in Thailand. So actually, what happens is this stock I've been observing is constantly being pumped up or kept at these levels because of good management guidance, but it is not reflecting in the performance. Chemical business 40% sale mix and 59% of the EBIT mix is hit by continued weakness in demand, reduced realization, unabsorbed overhead, as well as depreciation from new projects, contrary to the expectations of demand recovery and sequential growth. I'll show you. They are just doing capex, increasing capacity, and there is no improvement in revenue. So I don't know why they are doing so much of capex. Specialty chemicals saw sequentially weak operating performance hit by continued inventory realization in agrochemicals and price pressure caused by Chinese inventory push. US showed weak demand for HFCs. Uh, the domestic market achieved highest ever volume on H1. Pricing pressure in chloromethanes has also dragged performance. HFC demand is going because of uh, global warming concerns, etc. Packaging film business 41% sales mix and 20% EBIT mix saw 26% growth in sales and 7% jump in EBIT in Q2 FY25, led by domestic improvement in BOPT prices despite demand supply mismatch, higher BOPP margins, and higher value added project sales. Technical textile business 16% sales mix and 17% of EBIT. Sales grew 6% while EBIT fell 5% with stable contribution from NTCF. NTCF is nylon tire called fabric. This is a textile reinforcement used in various types of tires. Highest ever quarterly volumes in Q2, and PIY, which is polyester industrial yarn, whereas margins for belting fabrics are impacted due to aggressive pricing from China. Sustained lower prices in agri supply chain due to China will be concern for earnings. Management remains cautiously optimist, avoiding any growth guidance for FY25. So if you see their quarterly performance, the revenues declined 1.1% Q on Q and was up 7.8% year on year. But they have been slightly weak over the period of last year plus. Gross margins also declined and up year on year around 2%. So gross margins, if you see over a period of time, have been declining to come down to around 46.4%. Uh, Operating margins are also declining, have come down from 20 odd to 16. EBIT margins are also declining, and net profit margins are nearly becoming half now. And core EPS has declined around 15% over a period of last year or so. Segmental revenues breakup, they have three segments basically: technical textile business, chemical and polymer business, and packaging film business. So this chemical and polymer business CPB is declining, which was their main thing, and it was highest revenue earner, but that is declining, and now the packaging film business is becoming the highest revenue earner, and it is up 26% year on year. While technical textile business is generally flat, and EBIT wise, technical textile business year on year has declined, and EBIT for chemical business is also declined roughly 30%, while packaging is up 7.2%, and overall EBIT has declined 20%. So slightly weak. TTB and PFB sustained performance sequentially. The main earning drivers, chemical business continues to underperform, which you can see now here. That as a chemical business, the revenues are declining year on year. Chemical segment witnessed one of the weakest margins in Q2 that poses a big threat to FY25 profitability. So if you see here, this is the chemical business margins. See how they are declining. They used to be the highest. Then the packaging film business, these are low margin business, and they are also generally at the same level. And others and technical textile business also, it has been declining. Now, US export mix of HFC 125 has already marginalized post the HFC phase down. But nobody is interested now in HFC. Going ahead, the reference gas contribution from US is expected to shift in favor of Middle East and India. So they'll have to start selling HFCs to other parts of the world, and that sale is declining. Pricing of most HFCs has already fallen from the peak, led by sharp drop in demand owing to cuts in the US. However, R32, which is relatively a lower GWP gas, global warming potential gas prices have remained steady. So balance all HFC prices are falling. Only the other one, this GWP is which is R32 is still better. Specialty chemicals export witnessed sequential weakness due to subdued agrochemical demand. HFC demand in US is structurally falling, and focus will now be on Middle East and India. So this is for reference to gas and specialty chemicals. So this is their core business, which is declining. Uh, the problem is they are just doing capex. I don't know for what. While SRF investment guidance of 15,000 odd crore over FY23 and 28 provides long-term growth visibility, the indicated disproportionate rise in capex for chemical segment drives value growth for SRF ahead. So what is, if you are seeing here, chemical and polymer business, they are just doing capex, increasing capacity. Packaging film business also they are doing capex, and technical textile business also they have been doing capex. But it is only making it overcapitalized. Now, if you see here, net sales were declining in FY24, has gone up by around 11%, but will it go up in FY26-27? Slightly doubtful. EBIT, EBITDA growth was just 5% for FY25. Higher growth is expected, but we'll have to see this. And margins are generally stable, not moving up. Net profit declined uh, for FY25, expected to decline year on year, and it is expected to go up around 50% around. But I'm have to be skeptical on this, and we have to watch this whether these kind of profit numbers are achieved. Right now, the FY25 EPS is around 43. So at 43, with no growth, at 50 times, it is very expensive stock. So one has to be cautious with this, and it can get derated very quickly. The expectations are FY26 and 27 are pretty good. It is expected to nearly double revenue, but we'll have to see whether it is actually able to do that. Return on equity also is right now down this year, this financial year, but expected to go up. Asset turnover is pathetic. That means they are not efficient just one time. So that means whatever cost they have taken for creating assets, they are only doing the revenue as per that only, that much only. Uh, PE presently is expensive, around 50 times. So I think it should come down. So now, if you see, the stock has done nothing over this year. Generally, in the same region where it gets excited, it goes up to 2600, 2700, then comes down very quickly to this 2100 or 2000 level. So be careful for this. In case you are holding the stock, my recommendation is on every rally, sell this stock and exit this because there is not much is expected and it is trading much below the 200 EMA, etc. So I have finished. We'll take questions now.